I'm Matt Bouchard with REIT.com here in San Francisco for REITWorld 2013. Joining me for this CEO Spotlight is Jeff Hanson, the Chairman and CEO of Griffin-American Healthcare REIT II. Jeff, thanks so much for joining us.
Thanks for having me. Pleasure.
Let's start with the fundamentals in your sector, which certainly have been very favorable of late. How do you see those trends continuing for the various property types you own?
Well, as you know, Matt, we're a $3 billion REIT. We are a diversified healthcare REIT, so we own across what we refer to as all four clinical classes of healthcare real estate, so medical office buildings, assisted living facilities, skilled nursing, and hospitals. So I think that everybody is well aware these days of the demographic trends, and that is, I think, the demographic trends in this nation that will literally reshape the fabric of the country over not the next few years, but the next several decades, bode frankly very well for anything that's healthcare related, particularly the four clinical classes.
And earlier this year, your company expanded its portfolio internationally. What plans do you have to add to those offerings, and are there any particular regions or markets that you're looking at?
We have $2.2 billion in assets today, growing very rapidly. That consists of 30 states throughout the U.S., as well as you mentioned, a significant and strategic acquisition that we made earlier this year of the Caring Home senior housing portfolio in the UK. It was roughly a $470 million deal. I think that what I can say is in the near term and the midterm, you'll see us continue to grow with Caring Homes as one of the best operators of senior housing in the UK. We'll fuel as a capital partner their growth. Relationship is very important to us in that regard. That's our goal with any single tenant operator across the three single tenant classes, whether it's here in the US or abroad. I think that as we continue to round out the build out of our portfolio prior to a strategic event, you can expect to see us, other than the built-in growth that we have with Caring Homes in the UK, you can expect to see us continue to build the portfolio out here in the US. We all know that there's over $1 trillion inventory base in healthcare-related real estate right here in our backyard. An incredible aggregation opportunity. It's only 8 or 9% institutionally owned, which is far below any of the other product sectors. So we see a lot of growth potential across all four clinical classes in the U.S., and I think that's where we'll focus at least over the next 2 or 3 quarters. If we end up selecting an IPO or a listing as the alternative to create liquidity for current shareholders, you can expect us to see us, I think, in the long run, evaluate markets that are very similar to the U.S. and make strategic investment decisions.
Picking up on that last point, I'm sure here at REITworld you get asked the question quite a bit about the potential for an IPO, and we've seen that window for REITs open a little bit this year. How likely is that an outcome for your company?
I'm fairly limited given where we are with the company today. We just shut our equity offering down after 3.5 years just a month and a half ago. We raised $1 billion in new equity capital in the third quarter prior to shutting the offering down. So I'm limited in terms of how much I can elaborate there, but I will tell you that the board is currently considering strategic options as we deploy the remaining capital to get to what we call full build out prior to a strategic event. But I think that I'd say 2 things there. Number one, the performance metrics that we've been able to drive in each of the subsectors of our broader portfolio in all 4 classes of real estate compare very, very well to our peers, our publicly traded REIT peers. And secondly, the way we've constructed our balance sheet, very low leverage. We've grown tremendously over the last 3 years, yet we've been able to do it while ending the third quarter this year with just under 12% debt financing based upon aggregate acquisition value. And I think at full build out over the next couple quarters, you'll see us max out at 30% leverage prior to a liquidity event, with 80 to 90% of our entire portfolio unencumbered. So suffice it to say, I think that we've constructed certainly an investment grade profile balance sheet with the right performance metrics that are outsized in many respects relative to our peers, and that ultimately keeps the playing field and the options wide open for the board.
Great. Well, Jeff, we look forward to watching the progress.
Okay, thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.